the market is realizing that we are very, very close to the point where the Fed is going to stop tightening, but they won't have killed inflation. And people say to me sometimes, well, if there's a recession, that's going to cause inflation to come down, isn't it? Because, you know, other things being equal, of course,
right.
in a recession, there's less demand. So prices come down. And the answer to that is yes. But that's looking at it in a very, very immediate and short term.
The Fed's current rate policy is a drastic shift from its easy money stance that was in effect dating back to the financial crisis of 2008. Over much of that period, including 2020 and 2021, the Fed funds rate was set to a range of 0.00% to 0.25%. In March 2022, as inflation surged, the Fed shifted course and rapidly raised rates throughout the remainder of 2022 and into 2023. According to Adrian, we are approaching a crucial point where the Federal Reserve is on the verge of halting its tightening measures. However, this won't necessarily mean that inflation has been completely controlled. Over the past month, gold and silver prices have been declining, mainly due to a stronger U.S. dollar and the Fed's possibility of continued interest rate hikes. Gold becomes less appealing when interest rates are higher, especially in the long run. The beginning of this week indicates an upward trend, particularly evident in silver, which has experienced a more than 7% increase since Monday. Adrian believes that gold and silver are poised to experience a significant increase because silver, despite having distinct demand and supply characteristics from gold, functions much like a monetary metal. He's been asserting for a while that the upsurge in gold and silver prices will occur when the market realizes that the Fed is about to cease tightening before fully eradicating inflation. Adrian's outlook on the current situation is that inflation is suppressed while the Fed attempts to manage it. If the Fed does pivot, gold would likely soar, while gold might experience a temporary setback during a recession. However, history indicates that such a setback would probably be short-lived, and gold would eventually surge again. We will now bring you clips from Adrian Day's interviews with Wall Street Silver. But before we do, if you want more videos like this, make sure to hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
My basic approach to gold for the last 18 months has been gold and silver will take off because silver really acts like it is a monetary metal,
Right.
but it acts like a monetary metal primarily, notwithstanding the difference in demand, the difference in supply characteristics from gold.
Right.
We talked about that before. But when you look at when you look at the price of silver, it really does act like a monetary metal. So I've said for 18 months, gold and silver will really take off when the market believes, comes to realize, appreciates, whatever you want, when the market believes that the Fed will stop tightening before they have killed inflation, right? And we are very, very close to that point now. And, you know, we saw end of last year, even though inflation rates were coming down, gold went up because there was a lot of talk about a pivot.
Right.
Didn't happen. And so gold retreated. So gold has been down for the except today, has been down for the last several months because the market is listening to what Powell says. They raised rates in July. I don't think that was a surprise, but they're listening to what Powell says. The dot plot is calling for even 2 more rate hikes before the end of the year. If we have a recession, that only adds pressure on the Fed to ease, and at the very minimum to stop tightening, but probably to ease. And you only have to look back again. If we look at the 1970s as a roadmap, you only have to look back to 1974, 1975, very, very sharp recession in the US. Gold took it on the chin for about, what, 8 months? And then it exploded upwards afterwards because inflation was not killed. It was only subdued temporarily. We have not killed inflation.
So we're kind of Yeah, in my view, the same thing too. We're kind of in that similar stage as we're subduing inflation while the Fed is trying to subdue inflation. And then possibly within the next, like, let's say gold does take a hit when they initially do pivot, then you're saying just like the 70s, after 7, 8 months, it took off because that's what history shows.
Well, let me just, I don't want to leave a misunderstanding. If they pivot, which
Right.
I'm not sure they will in the near term, but if they pivot, gold will take off.
Right.
I'm
Right.
saying if there's a recession, gold will retreat. But it'll be short term, in my view.
Yeah.
And that's really what we need to watch. And of course, what Powell says on Friday at Jackson Hole is going to be telling. Now, he hasn't spoken yet, but you and I probably know what he's going to say. He's going to say fighting inflation is our #1 priority. We're very aware of the pain it causes people. We're going to be data dependent.
Same script.
What?
It's the same script he always
I know what he's going to say. I would think if there's no surprise at Jackson Hole, that will be positive for gold.
2023 has seen the most significant bank failures since the global financial crisis 2007 to 09. The current banking emergency has claimed Silicon Valley Bank, Signature Bank, and First Republic Bank. However, Adrian sees that the banking or financial crisis is far from over, and the economy has not yet experienced the worst challenges. Moreover, Adrian emphasizes that monetary policy has a delayed effect on the economy. He cites Milton Friedman's observation that monetary policy has long and variable lags. This means that the impact of monetary policy changes can take time to be felt in the economy, and the length of time it takes can vary depending on the specific circumstances. He points out that it has only been a short time since interest rates started rising, and the full impact of these changes is still unknown. The current economic environment is characterized by a prolonged period of ultra-low interest rates. This has allowed entities like households and corporations to improve their financial positions. Let's get back to the interview.
No, I don't think we've seen the worst of the banking crisis or financial crisis more broadly, nor the worst of the economy by any means. I think, frankly, people who are expecting a no landing and think that all the problems are behind us are optimistic. I had another word in mind, but let's be polite. We've talked about this before from a macro point, if you stand back a little bit, not on a day-to-day, week-to-week basis, but just stand back a little bit, the message is really the same as it was last time, Ivan. But we're seeing things come into focus now. We must never forget that monetary policy works with long and variable lags. Milton Friedman said that. And, a lot of economists think it's 18 to 24 months after rates go positive. We've only had we've had less than a year and a quarter of increasing interest rates.
Right.
That's not a long time.
No.
We've been in positive, we've had positive real rates for 3 months now? So these things take a long time to work through the economy, and they take a particularly long time in the current circumstance when we had ultra low rates, excessively low rates for so long, meaning people, households, corporations had the ability to get their finances in a better shape.
Right.
So corporations, for example, most companies, took advantage of the low interest rates to term out their debt. And so if you look at corporate America in general, the amount of debt that had to be rolled over in the last 12 months as the Fed was raising rates was really pretty small compared with the balance sheets of corporations. That's going to, as each month passes, more and more companies have to refinance, and they're not refinancing. Let's just say it's a small business that used to get a loan, 5 years ago, 3 years ago, they could have got a loan at 7%. Now they have to refinance at 11%. Huge difference. And for AAA companies, the gap is, the difference is even wider.
Right.
In percentage terms. Similarly, households. you know, virtually every household in America refinanced their mortgage. They didn't all get the bottom, of course, but they all refinanced it. And if they could have afforded the 8% mortgage when they took it on, and they refinanced to 3.5, well, you know, that gives them excess money.
Yeah, absolutely.
And so the point I'm making is that you always have these long and variable lags in monetary policy, but now you have a particularly long runway because people started off, debt levels are enormous.
Right.
But people started off with without the problem of suddenly having to refinance at a much higher level. But we're seeing it not just in the US, but in Europe in particular. We had a whole slew of economic data from Europe this week, all of it negative. You look at the US, you know, and anecdotally or factually, you see that the Bureau of Labor Statistics, they revised downwards the March number of workers on the payrolls by over 300,000.
Wow.
So things aren't even as good as we were told they were.
Right.
The point I'm making is that we are heading inevitably, inexorably towards a recession in the US. I don't see any way to avoid it.
Gold prices may remain volatile in the short term because of uncertainty on the interest rate trajectory of the US Fed. Still, experts believe the medium to long-term outlook of the yellow metal remains bright, especially after the rate cuts begin. Will the Fed's actions and potential policy changes increase gold and silver prices? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.